A moving truck pulls up outside a storage facility, drops off 4 boxes from a mother's house after her funeral, and drives away. Nobody in that moment plans to still be paying for those boxes 3 years later. Most people are. Not because they forgot, because the price was never really about the boxes. Here's a stranger number to sit with first. The average self-storage facility can keep up to 72 cents of every dollar it brings in as pure profit, after every bill is paid. That's a better margin than most restaurants ever touch, better than most apartment buildings. Out of a building that is, physically, a shed with the hallway. Something about that doesn't add up, until you realize the shed was never really the product. The price that's built to disappear had said $10 for the first month, maybe half off for 3. Cheap enough that signing felt like barely a decision at all. That number is called a lease-up special, and it exists to solve exactly one problem for the facility, not for you. An empty unit earns nothing. Almost any rent beats no rent while the place fills up. You weren't getting a deal. You were the fix for an occupancy problem, and the discount was your fee for fixing it. Then month 3 or 4 arrives, and the price wakes up. Public self-storage REITs openly raise in-place tenants 8% to 15% a year, sometimes more. And the very first increase after a move-in special is usually the sharpest. It walks your rent back up to what the space was worth the whole time. Inside the industry, there's a clinical name for this: existing customer rate increase, ECRI. It isn't treated as a nuisance. It's treated as the single most important lever the business has. Why nobody calls to complain? Here's the part that should bother you more than the price itself. Almost nobody calls to complain. Not because the increase is small, because leaving costs more than staying. Picture what's actually in that unit. 150, 250 cubic feet of furniture, holiday decorations, a couch from an apartment you don't live in anymore. Moving it out to save $15 a month means renting a truck, finding a Saturday, finding somewhere else to put it. The average renter stays 12 to 18 months. And the data says almost everyone simply pays the increase rather than make that trip. The operator isn't gambling on your loyalty. They're pricing your reluctance to the dollar. That's the average. Plenty of units sit paid and untouched for years. Some tenants have been quietly funding the same locked door since before the pandemic, and the facility never has to ask why. Quick one for you. What's the strangest thing you or someone you know has kept paying to store? Long after you knew you'd never look at it again? Drop it below. And if you're already scrolling down there, the like and subscribe genuinely helps this channel. The facility that runs itselfers the strange part. A storage facility can be sitting almost empty and still be profitable. Walk into most facilities on a weekday afternoon, and you'll see almost nobody. One person behind a desk, maybe. A gate that opens with a code. A camera pointed at an empty hallway. That emptiness isn't neglect, it's the business model. Most operators treat 80% physical occupancy as break-even, the point where rent finally covers debt and running costs. National occupancy across the industry typically sits between 85% and 92%. Above that break-even line, almost every extra dollar drops straight to profit, because there's barely any staff left to pay out of it. A 100-unit apartment building needs maintenance crews and leasing agents, and someone answering a call about a broken dishwasher at 11 p.m. A 100-unit storage facility needs a gate code. You're not paying rent to a business that serves you. You're funding a machine that mostly runs itself, and you're distracted. On-time payment is the fuel, but rent increases aren't even the cleverest part. The real money starts after you've already signed the paperwork. The fine print under the rent before you ever move a box in. There's a form to sign, and buried in it is a requirement almost nobody reads closely: mandatory insurance. Your own policy with proof, or theirs. And theirs is the default nearly everyone picks, because it's easier. It runs $10 to $20 a month for about $2,000 of coverage. And that one line item alone can make up 10% to 15% of a facility's entire gross revenue. On a product, the operator barely has to lift a finger to administer, because a third party underwrites it. Then there's the counter, a lock, marked up, boxes, a cut of every U-Haul that gets rented off the lot out front, A patch of gravel with paint lines and a spray-painted number, rented out as RV or boat parking for $50 a month. None of it needs a building, a crew, or a mortgage. It just needs a customer who already showed up for something else. Stack all of it on top of rent, and you land inside the 40% to 60% profit margins. This industry quietly runs out of a business that, from the parking lot, looks like the least sophisticated operation imaginable. The room nobody talks about. Eventually, somewhere in every facility, a tenant stops paying. This is the part of the industry that became a reality TV show, and the cameras usually miss the actual mechanics. Public Storage's own website walks customers through exactly how it works. State lien law governs the process closely. A legally defined waiting period. Formal notices by mail, phone, and email. And only after all of that can the facility place a lien and auction off what's inside. Somewhere on an ordinary Tuesday, an employee cuts a lock on a stranger's unit. Divorce boxes, a dead relative's furniture, a business that didn't make it, and a handful of strangers. In the parking lot, get 60 seconds to look inside before a bidder buys the whole contents for less than a used couch would cost. But watch what's actually being sold in that room. Because it isn't really the unpaid rent. Back rent on a small unit is often a few $100s, and most auctions never fully recoup it. What the facility is actually buying with that auction is speed clearing a defaulted unit in days instead of months, so it can go back on the market at full price to the next person standing in the lobby. The stranger's belongings are almost incidental. The product being sold is the empty room itself, not a villain. A systemate would be easy to end the story there, but that flattens something more interesting. Self-storage exists because life produces more possessions than most housing can absorb at the exact moment people need it absorbed. A parent dies and the house needs clearing before it sells. A couple separates mid-divorce and needs somewhere neutral, unaligned with either address, to put half a household for 6 months. A small business outgrows its rented office 2 years before it can afford a bigger lease and needs somewhere to put the extra inventory in the meantime. In every one of those rooms, a storage unit is doing exactly the job it claims to cheaper, unit for unit, than renting more square footage anywhere else. The utility is real, and millions of people are genuinely better off because this industry exists. What's also true, at the same time, the exact features that make storage useful to a grieving family: low labor, minimal maintenance, month-to-month flexibility, tenants too busy or too tired to negotiate, are the same features that make it one of the most efficient asset classes an investor can own. The kindness and the extraction aren't separate businesses. They run on the same mechanism, in the same 10 by 10 room, and nobody at head office has to target anyone personally for it to work. The system just needs a customer base too distracted to check whether a better rate exists 2 exits down the highway. Month after month, that turns out to be almost everyone. The earnings call you never hear somewhere. On a quarterly investor call, an executive in a glass conference room is reading out the same numbers that showed up on your invoice, just with different names attached. No mention of the boxes, the funeral, or the divorce. In 2020 alone, Public Storage posted same-store net operating income of nearly $1.75 billion and told investors to expect another 10% or more the following year. Extra Space Storage posted close to $717 million the same year, forecasting growth in the mid-teens. On top of that, those aren't estimates of how much space people needed that quarter. They're a direct readout of your rate increase, your mandatory insurance, and the friction that kept you from ever picking up the phone. Every extra dollar an operator squeezes out of you doesn't just become $1 of profit. It increases what the entire facility is worth. A rent increase that feels small to you gets multiplied many times over the moment the building changes hands. A small hike today can add hundreds of thousands of dollars to the property's sale price tomorrow. And plenty of independent owners never even build their own version of this playbook. They simply sign a management agreement with Public Storage, Extra Space, or CubeSmart, hand over pricing and leasing for a slice of revenue, and inherit the exact algorithm that made the REIT profitable in the first place. The small, local-looking facility down the street from you may be running the identical playbook as the billion-dollar public company. Just a different name on the sign. It didn't rent you a room. It rented your reluctance to move. If this changed how you look at that orange sign next time you drive past it, a like and subscribe genuinely helps the channel. And if you want to watch another everyday business quietly run the same trick in a completely different aisle, the video on how thrift stores actually make their money is a good one to go to next. See you in the next one.